Hello, it's Bob Steele. In this lecture, we will continue on Chapter 11. We will be moving on to payroll liabilities. So once again, we're going to be in the liabilities section. If you imagine the trial balance, we're in the liabilities section, and we are in payroll liabilities, focusing in on the specific liabilities here. So employers incur expenses and liabilities from having employees. So under gross pay are all these basically expenses that are under the gross pay for the employer. So when we, the employer, pay the employee, the simplest journal entry that you would think would be to basically credit cash for reduced cash and debit the wages expense. But of course, as we give the employee wages, we have some other responsibilities, one being the government. So it would be an A to B transaction, meaning we're going to just pay the employee. But now we have at least one other person being the government, and the government requires us to withhold. So instead of us giving the money to the employee and the employee giving it to the government doesn't really trust that to happen, I don't think. So what happens is we need to withhold from the paycheck and give that to the government and then give the employee the difference. So when we talk about gross pay, as far as what comes out of our paycheck for the employee, basically if we told them we're going to pay them $100 and that's the gross pay, that's what we're going to deduct. But we're going to split that amount out and say, well, if we were going to give the employee this amount, we have to take from them the federal income tax and withhold that, then pay it to the government. We got to take the state and local taxes on the income tax if they have income tax. Not all states do, of course, California does. And if they have any voluntary tax deductions, such as if we have a healthcare plan or a 401k plan, we would need to remove that. Those are good things to the employee. Those are things that the employee would choose to do. And then we have the FICA taxes, which are going to be Medicare and Social Security, which again are mandatory for us to take from the employees based on a more of a flat rate rather than a progressive rate like the federal tax. And then the difference there would be the net pay, the pay that we actually give to the employee. So we have the Employee FICA taxes, Federal Insurance Contributions Act. So that's going to be standing for FICA. There's two parts of FICA: Social Security and Medicare. So a lot of people get the acronyms kind of confused. FICA, the Federal Insurance Contribution Act, includes both the Social Security portion and the Medicare portion. So in 2014, the rates are fixed. These are kind of simple taxes to calculate because they're flat rates, meaning the Social Security is 6.2% of our gross income up to a cap of $117,000. And a cap basically means that we're going to pay 6%, 6.2% until we hit that cap. Then we no longer pay the Social Security tax. And you might be thinking that seems kind of weird to do that. The argument for that is that once we hit 117, it's not helping us in our benefits. So of course, the more we put into Social Security, the more that we basically get back upon retirement. But the retirement benefits that we receive from paying into the system go down as our wages basically go up. So the weight of the amount that we'll receive goes down as wages go up because it's kind of it's partially a safety net program, and there's no longer any benefit that we will receive upon retirement after the cap level. That's kind of just a general reason why there's a cap. Of course, that cap has gone up over time, and it's always a political topic as to if we need to raise taxes. Should we raise, the cap on Social Security? And there's also a difference between should we raise the cap on the employer and the employee side. The Medicare doesn't have a cap, and it's 1.45%. So the Medicare, whatever the wages are, we just take 1.45%, and that is that. Employers must pay withheld taxes to the Internal Revenue Service. So employee income taxes, we have the federal income tax and the state income taxes. So remember, when we talk about income tax, the confusing thing here is that the employer, of course, also pays income taxes, but the employer is paying income taxes on their net income on their corporate tax return or on their flow-through tax return if they're a S corporation or something like that. The employee has to pay federal income tax on their wages, which we as the employer must deduct from them their wages and then pay to the Fed. The state could be the same way. Again, the states could differ. Some states don't have taxes. Some states do have taxes in terms of an income tax. So California basically obviously has an income tax, and we would have to do the same, basically the thing there. We'd have to deduct the taxes pay to the state. So amounts withheld depend on the employee's earnings, tax rate, and number of withholdings. So these are going to be more difficult. We're not going to spend a whole lot of time calculating these in this class because they are a progressive table rather than a flat tax. Therefore, they're going to be a lot more difficult to come up with the actual amounts. We have to take into account the amount of exemptions as well as their income. So employers must pay the taxes withheld from the employee's gross pay to the appropriate government agency. So employee voluntary deductions, amounts withheld depend on the employee's request. So these are good things to the employee. The employee is saying, please, I want you to hold this from my paycheck. So these things could include something like union dues, savings accounts, pension contributions, insurance premiums, and charity. So these are types of things that we can say voluntarily withhold from our paycheck. You know, most of them are pretty much voluntarily. So employers owe voluntary amounts withheld from the employee's gross pay to the designated agency. And the biggest voluntary things are going to be health insurance, oftentimes, and 401k benefits, which are really good things to the employee if the employee offers those and allows the employees to participate in those plans. Recording employee payroll deductions. So payroll's got one of the longest journal entries here. It's a really intimidating looking journal entry. If we break it down to its basics, it's not quite as bad, but it does take some time to really grasp the payroll journal entry here. So remember, if we were going to do the most simple thing before we had all these withholdings, the easiest thing to record payroll, if we owe someone money, if someone earned $2,000, we're just going to say, oh, well, we debit payroll expense like we would here. And then if we paid them cash, we would credit cash to make the cash go down for the same $2,000. If we ran payroll and then paid the payroll at a later date, which is often the case, then we're going to credit something like salaries payable or wages payable, a liability, because we didn't actually issue the check yet. We're going to issue it later. Now in this case, of course, the expense that we pay is not equivalent to the credit in the payable, which would have been cash if we paid cash or not, because the expense is at gross pay, what they earned, and the payable, or the cash that we would pay out, that we will pay out in the form of a check or checks to multiple employees, is net pay. And then we got to record the difference in all that. What's the difference between gross pay and net pay? And those differences are all some form of liability to us, because to us, it's the employee earned $2,000. The fact that we have to remove these amounts from their paycheck and pay these third-party individuals is us paying the debt on their behalf, not really our taxes. So in theory, we're pulling out Social Security, we're pulling out Medicare, we're pulling out federal income tax, we're pulling out insurance, medical insurance, union dues. These are all things that we pull out, but we don't get to keep, so it's not like we can credit revenue here. We have to credit the liability, meaning that we will then have to pay the cash in the future to these individuals. So notice that, of course, the debits equal the credits. Gross pay, net pay, all the taxes and whatnot that we withheld is the difference. Payroll expenses, payroll, employer payroll taxes. So on top of that big long journal entry we just did, we also have the employer taxes. So once again, the employer pays income tax, but they pay income tax on their net income. That's not a payroll tax. The employee payroll taxes are going to be that we need to match on our side, the employer side, FICA taxes, which is Social Security and Medicare taxes. So the employer pay amounts equal to the withholding from the employees. So the rate's the same. We're going to pay the same amount that the employee paid on their wages. So we're paying taxes not on our income in this case. We're paying taxes on our expense. We're paying taxes on the employee's income. That's our payroll tax item. And then on top of those FICA taxes, we have to pay federal and state unemployment taxes. So the federal and state unemployment taxes. So federal unemployment tax, also known as FUTA, 2014 6.2 on the first 7,000 of wages paid to each employee. A credit up to 5.4 is given to SUTA paid. Therefore, the net rate is 0.6. So in reality, the net rate is basically 0.6. Let me break this down for you real quick, or try. Basically, it kind of came out to the federal government wanted the state governments kind of to take up the unemployment tax in some ways. So they basically said, we're going to pass a rate of 6.2 unless the state implements the SUTA tax in such a way that we're happy with, and if they do that, then we'll give you a credit, which means we're basically going to reduce the federal rate by 5.4, the difference being 6%. So the result of that is basically saying, states, you better implement a SUTA tax, or the Fed's going to take the 6.2%. So of course the results of that would be that pretty much all the states implemented a SUTA tax so that they would be able to collect the SUTA tax in state rather than to go to the Fed. So these two taxes, even though they're state and Fed, are kind of linked. The federal tax kind of greatly influenced the tax policy of the states. So in 2014, so in essence, the rate is 0.6%, but for pretty much every state that has a SUTA tax. But if you get technical on it, the real rate is 6.2 minus the credit of 5.4. So then we have the 2014 basic rate of 5.4 on the first 7,000 of wages paid to each employee. Now, the 7,000 cap is a little bit tricky too, because the cap means that we no longer pay after someone earns 7,000. And 7,000, if someone's a full-time employee and they work the entire year, they're clearly going to earn more than 7,000 at minimum wage rates. So unlike the Social Security tax, which was, over 100,000, which not every employee is going to hit, the caps on the unemployment taxes are generally low enough that basically every employee hits it, which means, what that means is we're going to pay most of the FUTA and SUTA taxes in the first and second quarter, and we're going to pay far less in FUTA and SUTA taxes in the third and fourth quarters, because all of our employees will have earned greater than the 7,000 cap by that time, and therefore we no longer have to pay these amounts on them. So record the employer taxes. So on top of the last entry that we put in, now we're entering the employer payroll taxes, and we're going to debit the expense for payroll taxes, and then we're matching the Social Security and Medicare. So we have to pay another 124 and 29. So that's 6.2 again and 1.45, not on our wages, but on our expense, being the employee's wages. So we have to match their wages and pay the federal government based on the employee's wages, based on these basically flat rates here. Fairly easy for us to calculate. Then we have to pay on top of that the SUTA and FUTA, calculated at 2,000 times 5.4 for the state. So we owe that to the state, and FUTA, which we owe to the state. So notice that the last journal entry we had, being the employee journal entry, didn't have any payroll taxes expense, didn't have a payroll tax expense, even though we're paying payroll taxes, because the entire expense was what the employee earned. The payroll tax expense to us is only the employer portion of the taxes that we have to pay, which includes our portion of Social Security, Medicare, and then the unemployment, which the employee does not have to pay, and the federal unemployment that the employee does not have to pay.